Is a company car worth it? Offering employees company cars might sound like a great benefit for both the employer and the employee. However, it is very important for both parties to know the tax implications behind doing this. When company cars are offered to employees, both the employee and the employer will incur a benefit in kind charge. The employer will have to pay national insurance on the offer of the company car. The employee will have to pay the benefit in kind tax. The benefit in kind value is the P11D value of the vehicle multiplied by the CO2 emissions bracket, and this then gives you your benefit in kind amount. The benefit in kind amount is then multiplied by your tax bracket to come to the essential cost of having a company car. As a result, this can sometimes land up being a costly benefit, and you may be better off purchasing the car yourself. It is important, therefore, to look at the various elements that go into calculating the amount of tax charged on a company car. The main element to look at is the CO2 emissions, because this essentially is what the government are clamping down on. And secondly, the size, the retail price of the car, including delivery, any add-ons, and the tax for the first year of ownership of the car. From an employee's perspective, it usually is more cost-effective to have a company car than to lease an equivalent vehicle, but it is very important to know the tax implications before getting yourself a company car. Nowadays, you will have heard most people are going for electric vehicles. The reason for this is because the benefit in kind is calculated slightly differently. The government is obviously keen to reduce CO2 emissions and therefore get as many people into electric vehicles as possible, and as such, the benefit in kind is calculated as the list price of the vehicle multiplied by a certain percentage, which is increasing year on year. Currently, for the 24-25 tax year, it sits at 2%. So again, that's the list price times 2%. In 2025-26, that'll go to 3%, 2026-27 goes to 4%, 2027-28 to 5%, and so on. From an employer's perspective, you may wish to look at carpooling, which means that the vehicles are available for business use only, kept at the company's premises, but it still enables the employer to portray an image, a brand of vehicle throughout the company. It also ensures that people traveling for business and client-facing roles arrive in a safe, new vehicle. The next best alternative to electric vehicles is a plug-in hybrid. The further that the car can travel on battery only, the lower the benefit in kind tax will be, as a general rule. An alternative to offering company vehicles is to offer to pay mileage for employees. This mileage can be charged or paid out at the advisory rate of 45p per mile, up to 10,000 miles per annum, and 25p per mile thereafter. It is important that no mileage is paid on commuting to a regular place of work, and therefore it should only be when travelling for business purposes, but not to your usual place of work. It is important to note that fuel paid for by the company on behalf of the employee is a taxable benefit and will also appear on the P11D.